All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Tuesday, everybody. Today is May 20th, 2025. The top story this morning, something a lot of people are probably not talking about. Matter of fact, this live stream is probably not going to get a lot of views because this is one of those things where people look at the title and they say, why do I care about the Japanese bond market? This has nothing to do with me. And that is the wrong take. As a matter of fact, that is a very wrong take because we've learned on a couple of key dates recently that the Japanese bond market actually has a lot of influence over what happens in the U.S. stock market, your portfolio, your retirement, and the whole freaking economy. So what's going on this morning? We are seeing yields blow out in Japanese super long bonds. These are bonds with a duration of like 20 years, 30 years, 40 years. We're seeing double-digit moves in the percent yield on these bonds. And these bonds have been rising really for the last year. We've seen the interest rates rising. And again, when you see interest rates rising, you're seeing prices falling. That's an important distinction. But really, since Liberation Day, that rise in these Japanese long bonds has gone kind of vertical. And then, we had the big blink on April 9th after Liberation Day, and then they cooled off for a couple of days. But in just the last 2 weeks, we've seen these Japanese bonds have continued to sell off. The interest rates have continued to rise. And then this morning, they are shooting up vertically. Now, this is a very big deal. So what's going on here? Well, the Japanese central bank has been engaged in the most reckless, insane, easy monetary policy. I mean, these guys make our Federal Reserve look like hawks with what they've been doing for the last couple of years. And it's gotten to the point where pretty much the Bank of Japan is the market for long duration Japanese government bonds. There's like nobody else is even buying this stuff besides the Bank of Japan. And you might be saying, well, again, why do I care? Well, the Bank of Japan is trying to normalize. They're finally getting inflation rising, even though they've been trying to create it on purpose, if you can believe that. Now they want to stop. Now they want to back away from this policy, and they're finding out that's pretty hard. When the central bank is the market for something, when the central bank stops buying, that market collapses. And the only way to get anybody else interested in buying these long-duration Japanese government bonds is with significantly higher interest rates, i.e., the price has to fall until new buyers show up. And the price keeps falling and the new buyers ain't showing yet, which means it's got to rise even more. Now, again, why do you care? You care because of August 5th. You care because of April 9th. Those days where the U.S. bond market, along with the global bond market, was freaking TF out over, among other things, the collapse of the yen carry trade. We've talked about the yen carry trade on this channel a lot. For years, it's been very advantageous to borrow yen at next to nothing % interest in Japan, convert those yen to dollars, and then buy higher yielding assets in the U.S., like U.S. Treasury bonds, U.S. stocks. The interest you're paying on that yen is cheaper than the interest you're earning on those assets in the U.S. Plus, the Japanese currency was getting weaker, so you had Forex tailwinds, making that trade even more profitable. That arbitrage has been known as the yen carry trade. But since last summer, we've seen the Japanese currency has started to strengthen rapidly. We've seen Japanese interest rates have started to rise as the Japanese government tries to back away and the central bank backs away from this easy policy. So that arbitrage opportunity between the yen and the dollar and the Japanese assets and U.S. assets is getting smaller and smaller, which means people are selling those U.S. assets and moving back over to Japan in order to cover that short bet on the yen, that money that they borrowed. And when you get big blowouts higher in Japanese interest rates, that risks accelerating that unwind of the yen carry trade. And it looks like we could be on the cusp of that happening again. That caused a big freak out in the market last August, on August 5th. I mean, we opened up, the stock market opened up down like 2,000 points that day. And then again, that's one of the things that started happening after Liberation Day. We saw that trade pick up again. The yen started strengthening rapidly. People started unwinding. The Sell America trade was also the unwind of the yen carry trade. So we're seeing that happening as well. So what's happening in Japan this morning, maybe it's not making headlines yet. Maybe the guy on CNBC and Bloomberg isn't quite talking about that yet. But if this keeps up for another day or two, you damn well bet they will be talking about it. They'll be screaming about it from the top of their lungs. So that is a big story to keep an eye on this morning. We're going to be looking at that one. We'll look at those charts. There's a big move happening in those long bonds. Other news going on this morning, we've got Home Depot earnings. It was a slight miss, but the stock is actually up slightly. Couple of important things. Same-store sales globally were just barely negative, a fraction of a percent. U.S. same-store sales did rise a little bit. The U.S. consumer struggling, the housing market frozen. No big surprises there. But Home Depot did come out this morning and say, we are not going to raise prices because of tariffs. So seems investors like that. I'm sure consumers like that. Also going on this morning, Walmart is out there trying to save face. They're saying, actually, on second thought, we're going to eat some of those tariffs, which I don't really think is saying anything because I think Walmart was always going to eat some of those tariffs. You guys may recall Walmart came out and said, we're going to have to raise prices because of tariffs. And then President Trump went borderline Kamala with the price controls on Truth Social, blasting Walmart for raising the prices, saying, no, don't be so greedy. You make all this money. Greedflation. It's a bold call, Cotton. Let's see if that pays off for him. Well, Walmart is out here saying, no, we're going to eat some of the tariffs, which is really saying nothing because they were always going to eat some of the tariffs. They're still going to raise their prices. They're just trying to backtrack that talking point because Trump said a thing. Another interesting story came out yesterday. Klarna, the buy now, pay later vendor out of Europe, they're probably the second biggest buy now, pay later provider. They were supposed to IPO earlier this year, but they paused their plans. Well, they announced yesterday that their losses have doubled from a year ago, and that IPO remains on hold. Joke's on them. CoreWeave IPO'd around the same time Klarna was supposed to. CoreWeave's losses doubled from a year ago, and yet CoreWeave stock is up 100%. Somebody wants to explain that to me. I always thought the point of business was to make money, not to lose money. But hey, that's just me and my old-fashioned way of thinking. Maybe Klarna should have IPO'd because the stock would have rallied on those doubled losses. But look, what's really going on here with buy now, pay later is you've got fraud on both sides of that trade. All right, you've got the buy now, pay later vendors, in my opinion, are bold-faced lying about the number of people who are not paying them back. It just doesn't pass the sniff test. These buy now, pay later vendors are reporting delinquencies that are about a third of what the delinquencies are among the same borrower cohort anywhere else in the market where you have more visibility into the debt, like auto loans, like consumer credit, like student loans. By the way, shout out to my friends Melody and Laxganapathy who came on the channel yesterday, and we took a tour de France through the entire consumer credit market, and student loans are wreaking havoc in every single sector of consumer credit right now. Check that one out. Shout out to my friends Melody and Locks once again. But look, once again, both people on the buy now, pay later deal are lying. You've got the lenders are lying about how many people are paying back. And then you've got the borrowers who are like, yeah, sure, I'll pay you back. And a lot of them aren't. And that's why Klarna is losing money. It's just like nobody tells the truth. Nobody pays their debts. Nobody does what they're supposed to. And then you get buy now, pay later. Magic. We also got a lot of headlines about China this morning. It's pretty interesting. China's gold imports surged to an 11-month high in April. That is despite record high gold prices. You may recall we went as high as $3,500. Typically, higher prices leads to less buying. That's usually how that works. Not when we're talking about gold in China. The Chinese are buying gold like gangbusters right now. There's a couple of recent stories that this reminds me of. Last month, we talked about how the Chinese had lifted the limits on how much gold their banks were allowed to buy. And lo and behold, their banks went and bought that gold. Chinese gold buyers are now the marginal buyers. In other words, China pretty much has control over the price of gold now because price is determined at the margins. And remember that thing we were talking about yesterday with the European Central Bank warning about how a gold squeeze is a potential threat to financial stability? You think maybe that might have something to do with the fact that the Chinese are buying record amounts of gold despite all-time high prices? I'm beginning to think these two things might be related. So keep an eye on that one. We've also got some interesting data out of China this morning. Smartphone exports plunged to 2011 levels in the month of April. It seems the trade war hits smartphones first and hardest. Big plunge in smartphone exports from China. And China ran a record budget deficit from the month of January through April. Wait till you see how much money the Chinese government borrowed in the first 4 months of this year. Wow, they're going to make Uncle Sam blush with those numbers. And of course, we've got Chinese banks are cutting interest rates, more stimulus coming. Zerpenber is on the rise in China. No big surprise there. And we got a big warning from JP Morgan CEO Jamie Dimon this morning. He's out warning about complacency in markets. You're going to want to hear that one. So stick around to the end. But in the meantime, let's shrink my big melon of a head and let's see what's going on in the markets this morning. Whoops, we got that chart up a little premature. Hey, don't forget that like button and that subscribe button for the YouTube algorithm. Come on back tomorrow because we do this every morning. So come have your coffee with the melon heads. And right now, S&P 500 is in the red this morning, hence the bear thumbnail, but just barely, about 13 points, 0.22% lower. By the way, the market really shrugged off that downgrade yesterday. I mean, closing almost positive on the day. It really seemed like everybody's just like, yep, Uncle Sam's credit is BS. We all know it. They're never going to pay back the debt, and we're all just kind of pretending it isn't happening and buying stocks anyway. All right, good luck with that one. But right now, barely negative. The Dow, meanwhile, is down 9 points, essentially unchanged on the day, 0.02% lower. And the NASDAQ is off by 77 points, about a third of 1% lower this morning. So we got all three indexes are in the red, albeit not that much. We've got a slightly stronger dollar this morning, only 8 basis points, 100.45 for the DXY. Not a lot of movement there in the dollar and not a lot of movement in bonds either. We got the 30-year yield is at 4.959. That's up by about 2 basis points. The 10 years at 4.495, also up 2 points. And the 2 years at 3.985. That's up a fraction of a point, pretty much unchanged. The 1 month is down a fraction of a point at 4.300. Not a lot happening in U.S. bonds here. In the commodities board, we got a little bit of green here. Spot gold is up about $5 or 0.16% higher, $3,235 for spot gold. Spot silver is up about 9 cents, about a quarter of 1%, $32.44 for spot silver. I like the shiny. Copper's down by about 1%. Platinum is 2.7% lower. Platinum is 2.7% higher in the green here. Palladium is about 2% higher as well. And WTI crude is up about 8 cents, 0.13% higher for July WTI futures. They're at about $62.23. Looking over at Bitcoin, it's still looking like not quite ready to make up its mind here this morning. $104,617. That's about lower by about $1,000 from yesterday. Now we were threatening a breakout, right? We've been in this. We'll call this a pennant pattern or a triangle pattern, kind of like a consolidation where it looked like it wanted to break out. Maybe this was a false breakout here because we had that nice move this weekend and then selling right back off. So Bitcoin's still not quite sure where it wants to go. My gut tells me we have a pretty good chance at making at least another all-time high before winter sets in at some point in the fall or the late summer. Be careful on leverage as always. All right, let's talk about the big one this morning, guys. Japan's super long bond yields soar to records as market frets about demand. And look, there's no fret about it. There is no demand. If the Japanese central bank stops buying, that's it. There's nobody else to buy. And that's the problem. That's the problem when you fake markets, when you interfere with price signals. It's something that you have a hard time not doing once you've done it. The long-dated Japanese government bond yields soared to all-time highs on Tuesday with worries about demand catalyzed by a poor 20-year debt auction and a headache for the Bank of Japan as it attempts to exit from a decade of ultra-easy policy. The 20-year JGB yield rose as much as 15 basis points to 2.555%, the highest since October of 2000, after the Ministry of Finance announced the auction results in early afternoon in Tokyo. The 30-year JGB yield soared 17 points, while the 40-year yield surged 15 points, also an all-time high. Investors' demand for duration is structurally slowing down, JP Morgan analysts said in a research note. While price formation without intervention from the Ministry of Finance and the Bank of Japan is ideal, some form of action is needed to stop the collapse of super long JGBs at present, or there could be further super long bond shocks triggered by downgrades or additional fiscal measures. So this JP Morgan analyst is saying, hey, look, it's great if we could get the central bank and the government to stop messing with the bond market here. But if they don't keep messing with it, the bond market's going to go down even more, and we don't really want that. Well, great. I want a toilet made of solid gold, too. It's just not in the cards, baby. Super long JGB yields have been rising for weeks against the backdrop of elevated U.S. Treasury yields, with those on 30-year bonds spiking to 1.5-year peaks above 5%. Japan's central bank under Governor Kazuo Ueda has steadily been reducing support for the market by paring its monthly bond purchases, unwinding the aggressive monetary stimulus implemented by President Hirohito Kuroda. However, some bond market participants urge the BOJ to boost buying of super long bonds or terminate tapering for that maturity in the wake of sharp rises in their yields. A summary of opinions collected by the central bank showed on Tuesday. And they're saying, please start buying bonds again. Please stop this taper. We don't want our yields to rise anymore. And look at this chart, guys. This is the Japanese 40-year government bond yield. And again, you see this yield moving higher. This is the price moving lower. And look at this big move happening today. It's 16, 17 basis points now, an all-time high. Now, there's a couple of important dates I want to zero in on here. All right, starting in March with the lead up to Liberation Day, we saw this big sell-off in bonds. And then, of course, Liberation Day came and the Japanese bond market freaked out. Everybody ran for safety. People were buying. But then all of a sudden, the bond market says, you know what? I just second thought realized there's a whole bunch of risk here. I don't want to own government bonds during a trade war. And this sell-off started and the yields went vertical, ultimately culminating in Trump's kind of surrender. And then that moved even lower. We saw a little bit of a calm down. And then like about 2 weeks ago, this just started happening again. People started selling these Japanese government bonds. And then, of course, this morning, everything went apeshit. Now, let's zoom out a little bit, guys. The last time we had big moves like this was back in August. Now, that was short-lived, but here was the August 5th unwind of the yen carry trade panic. And you can see the move in long-dated government bonds for Japan much more pronounced than we had even during that hysteria in August of last summer. I'm really surprised this isn't getting more attention in the press right now. Now, that's just the bond yields. The yen, the actual currency, is another important one to watch. We talked about this one yesterday. We've seen the Japanese yen strengthen quite a bit over the last week or so. Again, you see this chart moving lower. This is USD JPY. That means it takes fewer yen to make $1, so the yen is strengthening here. We saw a rapid strengthening in the yen in the lead up and then immediate aftermath of Liberation Day. Then on some of the backtracking, we saw the yen start to re-strengthen. Now we're heading lower again. And again, I just want to zoom out here. This was that August 5th yen carry trade panic. So we haven't quite had a move that big yet, but we risk reigniting that yen carry trade unwind. And of course, that would be a very bad day for assets in the US and in Japan alike if that were to ever happen. And honestly, I think it's inevitable at this point. The Japanese government has to stop with this ultra easy monetary policy. The central bank has to stop buying the bonds. Nobody else is going to buy those bonds without significantly higher interest rates. And if those interest rates go higher, you're going to see the yen strengthen and you're going to see that carry trade unwind. So they got to thread the needle here, figure out a way to unwind this thing. All right, let's come back to the U.S. now. So let's talk about Home Depot here. They maintain their guidance as U.S. spending holds up. I use that term lightly. It held up, but just barely here. Home Depot maintained its guidance for the fiscal year as U.S. sales ticked up, a sign that consumer spending has held up despite economic turbulence. While the world's largest home improvement retailer said comparable sales dropped 0.3% for the 3 months ended May 4th, marking a slowdown from the previous quarter, the same metric in U.S. stores rose slightly, bolstered by smaller projects. February sales weighed on the quarter due to weather conditions across the country. Though demand improved in March and April, CFO Richard McPhail said in an interview, positive sales have continued through the first weeks of the current quarter. Our consumers are still telling us that the rate environment remains a consideration, and they tell us they are deferring larger projects for now, he said, adding that consumer habits remain steady. About 80% of Home Depot's customers own homes. The company maintained its full-year forecast, which includes the impact of tariffs. Comparable sales were hit by foreign exchange rates, and earnings missed Wall Street expectations. All right, so the frozen housing market means Home Depot continues to underperform here, although this was about in line with what we expected, maybe a little bit worse. But this is what's getting a lot of attention here this morning. Home Depot CFO says the retailer does not plan to raise prices due to tariffs. Home Depot on Tuesday stuck by its full-year sales forecast as top executives told CNBC the retailer doesn't plan to hike prices because of tariffs. Because of our scale, the great partnerships we have with our suppliers, and productivity that we continue to drive in our business, we intend to generally maintain our current pricing levels across our portfolio, said Richard McPhail in an interview. More than half of what the company sells comes from the U.S., he said. Now, I think that's probably being skewed a little bit by lumber. Home Depot gets a lot of their lumber sales, and I think a lot of U.S. lumber, a lot of lumber sold in the U.S. comes from the U.S., also from Canada. So tariffs on China are not going to impact lumber. A lot of the packaged things that Home Depot sells, though, that's almost certainly made in Asia. McPhail added that Home Depot and its suppliers have worked to diversify the source of the company's imports over the past several years, including by decreasing the share of purchases that come from China. By this time next year, no single country outside of the U.S. will represent more than 10% of the company's purchases, he said. For the full year, Home Depot said it expects total sales to grow by 2.8%. So Home Depot's actually doing pretty good here this morning. It was an earnings miss, but I think maintaining their guidance while a lot of other retailers are lowering or outright withdrawing their guidance, the market is reacting favorable to that. So we're up by about 2.5% here, trading at $389.02. That's up by $9.64 ahead of the opening bell. Meanwhile, on the tariff front, again, after Trump rages, Walmart says we'll eat some of the tariff costs. Again, I think this is just silly politics. I don't think Walmart is deciding not to raise prices here. Walmart, which drew the ire of President Trump, said its customers should brace for higher prices as a result of the White House tariff policies, has now said that it will absorb some of the impact of the tariffs. That is according to Treasury Secretary Scott Bessent. Speaking on NBC's Meet the Press, Secretary Bessent said he had talked with Walmart CEO Doug McMillon on Saturday. Bessent said Walmart is going to eat some of the tariffs, just as they did in 18, 19, and 20, referring to the tariffs implemented during the first Trump administration. I didn't apply any pressure. Doug and I have a very good relationship, so I just wanted to hear it from him rather than second, third hand from the press, Bessent added. The Treasury Secretary said that Walmart had given a worst-case scenario on the company's first quarter earnings call. The call between McMillon and Bessent was previously scheduled. We have always worked to keep our prices as low as possible, and we won't stop, Walmart said in a statement provided to MarketWatch. We will keep prices as low as we can for as long as we can, given the reality of small retail margins. So I don't think there's any real change to the Walmart story here. Again, I think this is just a bunch of political face saving and nothing more. Those prices at Walmart are still going to go up because of the tariffs. Meanwhile, Klarna doubles their losses in the first quarter as the IPO remains on hold. Got to question those 2.5% delinquency rates these buy now, pay later vendors keep reporting here. Klarna saw its losses jump in the first quarter as the popular buy now, pay later firm applies the brakes on a hotly anticipated U.S. initial public offering. The Swedish payment startup said its net loss for the first 3 months of 2025 totaled $99 million, significantly worse than the $47 million loss it reported a year ago. Klarna said this was due to several one-off costs related to depreciation, share-based payments, and restructuring. Revenues at the firm increased 13%. It comes as Klarna remains in pause mode regarding a hotly anticipated U.S. IPO. Look, guys, what they're not talking about here is why would Klarna's losses double in the first quarter? Okay, sure, maybe we got some share-based compensation, but at the end of the day, people are not paying these loans. That's what's going on here. Klarna is having trouble dumping this stuff on the ABS market, perhaps, and maybe they're having to sit on these loans a little longer than expected. And so they're booking the losses. But again, the joke's on them. They should have IPO'd anyway because CoreWeave just reported a doubling of their losses versus just 3 months ago. And CoreWeave stock has doubled. So maybe they should have IPO'd anyway because this market doesn't seem to care about companies that lose money. All right, let's talk about China now. We got a couple of headlines from China. First of all, this one, important one here. China gold imports surged to 11-month high despite record prices. Those higher prices did not dissuade Chinese buyers. China imported the most gold in nearly a year last month, despite record prices, after heightened demand for the precious metal prompted the central bank to ease restrictions on bullion inflows. Total gold imports to the country reached 127.5 metric tons, an 11-month high, according to customs data released Tuesday. This represents a 73% jump from a month earlier, even after gold hit successive all-time highs, at one point touching $3,500 an ounce. The rise in imports is likely due to the People's Bank of China allocating fresh quotas to some commercial banks in April, as the authority responds to strong demand from institutional and retail investors at the height of the trade war. The central bank controls fiscal bullion flows, typically granting import licenses and quotas only to select banks. Look, the Chinese are going crazy for gold here. It used to be the Chinese went gangbusters for real estate, but the real estate market collapsed in China. So the average household no longer trusts the housing market, so they're not going to put their money into housing. They don't really trust the stock market, especially not in the middle of a trade war. So where are Chinese going to put their money? Gold is the next logical place. And Chinese banks and central banks are doing the same thing. And guys, I can't help but think of that ECB note from yesterday when they said runaway gold prices could lead to a squeeze, to a possibly difficulty in delivering physical metal, and how that could actually be a threat to financial stability. And again, when central bankers talk about threats to financial stability, that is very strong language that they only reserve for very severe economic crisis scenarios. I can't help but think these two stories may be related because China is the marginal buyer now. China is that buyer on the edge that may or may not buy, and that's what determines the price. China is in control of gold prices now. Gold prices seem like they are going to keep going higher. We got some more Chinese stories here. Chinese smartphone exports to the U.S. plunged to the lowest since 2011. We won't spend too much time on this one, guys, but look, when the trade war hit, it seems like smartphones were hit first, hit hardest. Keep in mind a lot of those headlines about Apple trying to move their iPhone production out of China and into India, and President Trump wasn't too happy about that. He wants them to build their iPhones in America, something that's probably not going to happen anytime soon. God forbid American companies hire Americans to build products sold in America. What was I thinking? Well, China is losing their smartphone manufacturing. That seems clear, and it took a big drop. Let's just look at the number here. Smartphone exports slid 72% to just under $700 million last month, sharply outpacing the overall 21% drop in Chinese shipments to the U.S., detailed customs data showed on Tuesday. So a big decline in those phone shipments to the U.S. here, guys. India is the chief beneficiary of that one. And we got another interesting China headline this morning. China ran record budget deficit with spending blitz amid tariffs. Wow, they're taking their cues from Washington here. Look at this. China's fiscal stimulus pushed its 4-month budget deficit to a record high as the government ramped up support for the economy during an escalation in its trade conflict with the United States. The broad deficit reached 2.65 trillion yuan. That's about $367 billion US in the January to April, not quite quarter, that's 4 months. The most ever for the period, according to Bloomberg calculations based on data released by the Finance Ministry on Tuesday. The shortfall had swelled by more than 50% compared with a year earlier. So in 4 months, $367 billion. So, we're looking at a budget deficit annualized of about $1.1 trillion. That's about half of the rate of the U.S. budget deficit. China's not really known for big government deficits here, so they really blew out their spending in order to stimulate the economy amid that trade war. Just goes to show you, while all the headlines were like, oh my God, there's no cargo containers coming to the U.S. and all the small businesses are going to get clobbered. Look at what happened in China. Smartphone sales falling off a cliff, people running to gold, and of course, record budget deficits. Almost half of what the U.S. is currently borrowing. And look, maybe half seems like a small number to you guys, but we're talking about U.S. government deficits here. That is a freaking huge number. So the Chinese not getting off scot-free in this trade war. And meanwhile, Chinese banks cut their benchmark lending rates after PBOC easing. We're seeing them lower interest rates as well. We've had a couple of headlines about lower rates in China over the last few days. We had the PBOC cut their benchmark lending rates. Chinese banks have followed suit. We're also seeing Chinese banks cut the interest rates they're paying out on deposits, trying to stimulate more consumption. Remember, a lot of the efforts in China, as the U.S. pulls back from importing Chinese goods, the Chinese are trying to stimulate domestic consumption to offset that. Good luck. You're just not going to replace the American consumer by convincing your people to buy more with a fraction of a percent lower interest rate on their bank deposits. And the last one I want to talk about this morning, JP Morgan CEO Jamie Dimon says markets are too complacent on tariffs and expects S&P 500 earnings growth to collapse. Some strong language from Jamie Dimon this morning, the CEO of the U.S.'s biggest bank. JP Morgan Chase CEO Jamie Dimon said Monday that markets and central bankers underappreciate the risks created by record U.S. deficits, tariffs, and international tensions. Dimon said the veteran CEO, Dimon, the veteran CEO and chairman of the biggest U.S. bank by assets, explained his worldview during his bank's annual Investor Day meeting in New York. He said he believes the risks of higher inflation and even stagflation aren't properly represented by stock market values, which have staged a comeback from lows in April. We have huge deficits. We have what I consider almost complacent central banks, Dimon said. You all think they can manage all this? I don't think they can, he said. My own view is people feel pretty good because you haven't seen effective tariffs. The market came down 10%. It's back up 10%. That's an extraordinary amount of complacency. Dimon said on Monday he believed Wall Street earnings estimates for S&P 500 companies, which have already declined in the first weeks of Trump's trade policies, will fall further as companies pull or lower guidance amid uncertainty. In 6 months, those projections will fall to 0% earnings growth and starting the year at around 12%, Dimon said. If that were to happen, stock prices will likely fall. I think earnings estimates will come down, which means PE will come down, Dimon said, referring to the price-to-earnings ratio tracked closely by stock market analysts. The odds of stagflation, which is basically a recession with inflation, are roughly double what the market thinks it is, Dimon added. So some pretty strong language from JP Morgan CEO Jamie Dimon this morning, which he is known to do, by the way. He's something of an amateur doomer, believe it or not. But some pretty strong language there. The market is very complacent. And I just want to say thank you so much to Mr. Ziebelfritz, who says, when the dust settles, no more central banks. Ziebelfritz, don't threaten me with a good time. Look, we went, the first 150 years in this country or something like that. Don't make me do math. About the first century and a half, this country did not have a central bank. And was it really so terrible? Hey, we didn't all vanish off the face of the earth. We got along just fine without a central bank. I don't know. Maybe just try it. The Fed ruins things. The Fed causes inflation. The Fed causes market collapses. Maybe we should try just not having a Fed. Not a bad idea, Ziebelfritz. And thank you so much for being a melonhead for 11 months. Richard Bell, what's going on, sir? He says, Huang and Musk, infinite growth in a finite world. Why don't we throw Michael Saylor in there while we're at it? Since we're talking about infinite money glitches, I think Mr. Saylor is probably vying for the bronze medal in that category. Look, infinite money glitches work until they don't. Sooner or later, people are going to realize that what's going on in the AI market is just an accounting gimmick. You have a neat technology with a whole lot of potential, emphasis potential, because it hasn't made anybody any money yet. Only the hardware vendors are making money. None of the AI companies make any money. They actually lose money at an even faster rate than they used to. So the path to profitability right now is further away from profitability, not closer. But for the time being, big tech continues to play this game of CapEx chicken, where they're all just having a contest to see who can light a bigger pile of their shareholders' money on fire. And whoever comes to their senses first loses. So as long as that is the prevailing wisdom, air quotes, in big tech, then this AI bubble will continue. Sooner or later, they're going to have to stop it, though. Right now, it's looking like later because this has gone on for 2 years now. It's insane how long it's gone on for. But thank you very much, Mr. Bell, for supporting the channel. Nashville Pasta Man, what's going on, brother? He says, buy now, pay later on a credit card. Oh, the irony. I have seen stories about that, about people trying to pay their BNPL loans with their credit cards, trying to fix a bad decision with an even worse decision. In this case, two negatives do not multiply out and create a positive. That's not a good idea. Yeah, the irony indeed of buy now, pay later there. Look, guys, BNPL, They're rubber stamping loans to people with lousy credit. A lot of them are not paying. They're lying about who's paying. And ultimately, while they're lying about who's paying and while people are lying about borrowing money and not paying it back, it's ultimately being sold to us. That's the real problem, is the ABS market is allowing these BNPL companies to package these dog shit loans into bonds and sell them to you and me in the form of our pension funds, IRAs, and mutual funds, where the people who are buying them are these finance bro fund managers who don't have any skin in the game, and they don't care. They just buy whoever gives them the biggest kickback. And so that's one of the reasons why I've been ringing the bell on buy now, pay later for like about the last year and a half now. I've been trying to warn, and my new friend Lox Ganapathy from Unicus Research has also been warning about these buy now, pay later firms. I think we'll be hearing more about that in the months ahead. Thanks again, Pasta Man, for supporting the channel. Pigo's Trading Desk says, I can feel Gayed's annoying swelling in him. Yes, Michael Gayed is the undisputed king of the doomerism when it comes to the yen carry trade. And look, I am not using that doomer phrase as in a pejorative context here. You guys know I am a proud doomer. I wear that badge in invisible ink right next to my Perma-Bear label on my shoulder there. But Gayed has been warning about the yen carry trade for years. I had him on the channel, I think it was in like January of 2024. It might even have been late 2023. And we were talking about the yen carry trade. And it's been one of those risks that's been out there. It came to the forefront very briefly in August, caused a lot of headache on August 5th, and then it kind of fizzled out. It came back to the forefront with Liberation Day. If these moves in the super long JGBs continue, if we keep getting these rates blowing out, then we're going to see the yen strengthen again, and we could see that story come back to the forefront. And yes, Mr. Gayed will be peak annoying if and when that happens, and I think he deserves it. Thanks again, Pigo, for supporting the channel. Dan Pride, thank you, sir, for supporting the channel. Nothing, no question or anything like that, just being a swell guy. Thank you very much, Dan Pride. I appreciate that. By the way, Mish, if there was a question there, could you do me a favor and text that to me so I don't have to dig it out of the stack here, and we can just keep this show moving. Thanks again, Dan, for supporting the channel. Armando Reyes says, when are you going to bring real estate mindset in on your videos? Tell how the schools are broke and how they're stealing pensions and 401ks. You know, that is a great idea, Armando. Travis and Mitch have done fantastic work over there with what's been going on in the bond market, and in not so much in the bond market. They have touched on the bond market, but with these revaluations and the property tax assessments, the gist of it is what's going on is the schools, or so the theory goes, the schools are telling the county assessors, look, we need money. We've spent all this money, or, you know, we've already sold bonds based on future tax receipts that haven't even been passed yet. We need you guys to go raise property values. We need about X million dollars. And then the county appraisal districts just go and they say, okay, in order to raise this much dollars, we need to reassess homes this much. And then they go out and they do it and they raise property taxes. And, you know, if you're a senior citizen, if your grandma living on a fixed income and your property taxes double from a year ago, you lose your home. You can't just eat that property tax. You've already eaten a 30% increase in your cost of living. And so Travis and Mitch are all over this story. They're doing an awesome job. Travis is actually taking these county appraisal districts to court, which is a brave move, to be honest with you. It's a gutsy move, Travis, that you're doing that. So shout out to my buddy Real Estate Mindset. And thank you, Armando, for supporting the channel, sir. Appreciate the good vibes. Madison Hype says, buy now, pay later is bought on credit cards. Loan moves to card. It's not necessarily a credit card. Buy now, pay later is its own thing. You enter your information when you check out, and it doesn't go on your Visa or your Amex. They supposedly run a credit check on you. I don't know how, because you don't enter all that much information. Really, their AI just says, oh, artificial intelligence did a thing, put glue on your pizza, you're approved. And, well, magically, a lot of these people are not paying them back. Go figure. So loans move to card. What it's talking about there is that people are now trying to pay these bills using their credit card to pay the buy now, pay later payments. I do believe there was some move by the CFPB to try to stop that last year. I don't remember if that rule actually got implemented or not. But some credit card companies have already told people, we're not going to let you pay your buy now, pay later loans using our credit card. If you want to pay a checkout, pay with our card. You're not going to pay with our card after the fact. So thank you very much, Madison, for supporting the channel. Chuck G, what's going on, Charles? He says China flipped out over Trump telling companies to not buy Huawei chips too. probably over SpaTech. Look, Huawei is just one of those just absolutely awful Chinese tech companies. And look, I think our tech companies are kind of awful too, but the Chinese tech companies take the cake. Huawei chips, anything with a Huawei chip on it, you can just assume anything and everything on that device is going right to some data center in China. That's the one thing we've learned. By the way, Xfusion, the company that was buying those GPUs for Hyperscale Nexus, they were a spinoff of Huawei. Remember that whole thing about, the European drug cartel that was using drug proceeds, laundering them by buying GPUs and smuggling them into China? Oh, that was a thing. Yeah, by the way, nobody cared about that story. A year later, that just blows me away that story was just like, oh, whoops, you caught us with our billion-dollar drug money laundering scheme. Good job. We're going away now. 3 days after that video, they canceled it. Gotta love that. And nobody cared. Pretty amazing when you think about it. I mean, I probably could have got more views if I did the eat 15 saltines in 10-second challenge, but I try to be a little bit more cerebral than that on this channel. Anyways, yes, definitely over SpyTech is what was driving that flip out over Huawei. I mean, Huawei is basically an instrument of Chinese intelligence gathering. And so, okay, China flipped out over that. Cry me a river, China. That's what it is. And if you don't want us to flip out over your chips spying on our companies, don't spy on our companies with your chips. Oh, amazing how that works. Thank you, Charles G, for supporting the channel. Pigo is back again. He says the saddest part, 90-year-olds are looking for a job. That is pretty sad. I don't know about 90-year-olds looking for a job, but I think people unretiring is going to be a thing, especially if we ever get any kind of price discovery in this debt market and the ABS market. That's what really drives me nuts the most, Pigo, about all these the floor is price discovery games that they're playing, all the way they're sweeping everything under the rug. For the last 2 or 3 years, the singular focus of Wall Street has been, how do we keep this bubble inflated while getting all of this crap off of our books and onto the balance sheets of retirement plans, pension funds, ETFs that are in 401ks and IRAs. They've been doing it for years. And all of these regulators and all of these government overseeing groups have done precisely nothing about it. And yeah, when that bubble pops, you are going to see a lot of people unretiring. And, people think this is like some kind of like doomer conspiracy theory that retirements might be going away. Guys, in the grand scheme of things, retirements was never a thing. For the first freaking 400,000 years of human civilization, or not civilization, since freaking cavemen, you worked until you died. That was a thing, like right up until maybe 100 years ago, the concept of retirement became a thing. So in the grand scheme of things, retirement may just go down in history as a failed social experiment because we're just too damn treacherous to trust each other to take care of ourselves in our old age. It's what it boils down to. You're on your own at this point, guys. Social Security, we all admit, is a Ponzi scheme. We all admit it is mathematically destined to fail. So that's already going to fail. And then we've got 401ks and IRAs that are meant to supplement Social Security. And the crooks have just been pigging out on them too. At the end of the day, retirement may just be a failed social experiment. Thank you, Pigo, for supporting the channel. And Will Yang, thank you, sir, for supporting the channel. He says, could China price gold in renminbi if bought enough? They could. They could say we're going to pay you in renminbi, but ultimately it's going to be the exchange rate that determines what that renminbi price is going to be. And as long as the dollar is the world's reserve currency, which it is, and nothing is even close yet, that renminbi is going to be floating against whatever the dollar price in gold is. So long story short, no, I don't think, at least not anytime soon. They would have to continue buying gold at the rate they're currently buying gold for several years straight to ever get anywhere near enough dominance in the market to be able to dictate that gold trade is now going to happen in renminbi. They just don't own enough gold to do that. But they're trending in that direction while the rest of the world is not. So it's a good thought, but I think we're probably still a ways off. And by the way, the whole BRICS gold currency thing, that's still a long, long way off. This war between India and Pakistan and the Chinese giving the Pakistanis missiles does not make the Indians want to get further in bed with the Chinese economically. So I don't think BRICS is really going to be an issue anytime soon either. Thank you, Bill Yang, for supporting the channel, sir. And thank you, everybody, for having your coffee with the Melon Heads this morning. I appreciate all the super chats and the generosity, as well as you, my magnanimous Melon Heads on Patreon and YouTube. You guys are awesome. Links down below should you feel so inclined. Don't forget to check out that interview I did with Locks and Melody yesterday. You're not going to want to miss that one. Also, don't forget that like button and that subscribe button for the algorithm. Hi, Mom. Hi, Dad. I love you guys. Everybody, till the next one, live small and dream big.